Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, November 14th, 5:15 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, a bear market rally is underway. If you check over here on the trend gauge, you can see we've got market leaders flagged as bullish slash uptrend, and then taking a look at the 5 major indexes, they are all trending above their short-term 21-day exponential moving average, above their medium-term 50-day moving average, but still can't get the NASDAQ 100 and the S&P above the long-term 200-day moving average. So kind of a mixed bag there. As far as what happened today, after a big gap up on CPI on Thursday and follow through to the upside on Friday, we ran into key fib levels on the Nasdaq and the S&P 500 and reversed there. So the reversal was kind of abrupt and kind of hard on the sell-off. That's why I've got it flagged in red, but no real chart damage done. So kind of want to soften the blow with this negative reversal and see what happens tomorrow after a big gap up and a follow through. It's normal to pause. And as I said, no significant damage done to charts. On the day, the G6 down 1.3%, S&P down 0.9%, NASDAQ 100 down 0.9%, Dow down 0.6%, mid caps down 1%, Russell 2000 small caps down 1.1%. Global diversified 60/40 stock and bond down 0.6. In-house, our GROTECTION portfolio down 0.15. We'll go to the tail of the tape and we'll go through our focus list on charts. But first, a brief explanation on why we do what we do here at Revere. Let me go to the S&P 500. And Revere is a fee-based only, conflict of interest free, fully transparent, SEC registered investment advisor. Registered with the SEC, that means we've got more than $100 million under management. We're not a mutual fund. We're not a hedge fund. We manage individual client accounts with various strategies. Our chief strategy is called GROTECTION, and it's designed to grow assets during market uptrends and protect them during downtrends. We manage individual client accounts using various trend following rules. When we're trending above the key moving averages across all 3 time frames, we're fully in the market, as comfortable as we can be at that point. That's an ideal market. In a neutral market, we'll start trending sideways. Some things will start to underperform. We'll sell them. Some stops will take us out. If we really start trending lower, the slope of the short and the midterm moving averages will roll over. That'll really be giving us a warning, and we significantly reduce exposure at that point. And if we break, in the worst case scenario, is a break below this black line. That's the 200-day moving average. And we are in a maximum defensive posture at that point, because history shows all of the severe bear markets take place below that key 200-day moving average. Here's some stats to back that up. These are the last 13 bear markets going back to 1968. The flagged ones or the shaded ones, 6 of them on average down 44.5%. If you're approaching retirement, you just do not want to take a big hit to your nest egg in a negative sequence of returns scenario. That's what these bear markets are. Do we recover from them? Sure. Sometimes it takes a decade. Sometimes it takes a year or less, as was the case with COVID. It was a panic and we recovered. But suppose the death rate for COVID ended up being 4% instead of a fraction of a percent. Where would the world and where would the markets be then? That's why we protect assets first. That's our number one job, is risk management. The returns take care of themselves when the market turns back to a healthy posture. And if you're interested in this approach, reach out to me. You can email don@revereasset.com, or my partner, Danny Stewart. He's the president of Revere. He handles all onboarding questions. You can email him at dan@revereasset.com. or you can call us at 855 Real Wealth. That's 855-732-5932. Let's take a look at key charts here and see what we happened. So you can see what happened on the day. So the big gap up on Thursday, follow through on Friday. We ran into 4007 is a key level, a key Fibonacci level. That means you take a high and a low, and you normally measure the key levels. There's three of them. There's a 38.2 retracement, a 50% retracement, and a 61.8 retracement. The 38.2 and the 61.8 are fib levels. The 50% is kind of a reference point for giving back half of a loss or taking back half of a gain. We use it all the time to gauge the weakness or strength of a pullback or a rally. In this case, we ran into 4007 on Friday, and then we ran into it again, actually got above it for a couple of minutes, basically. Let's take a look at a 5-minute chart here, and you can see this level. Let me get up the actual index. So you can see here for about, I don't know, half an hour, we were right at 4007, 4008, poked above it, but then we rolled over and started selling off into the close. This is just telling me that the market's pausing right here. It's pausing at a key level, the 61.8 fib, and it's a natural point to pause. The question is, what happens after this? Now, if we start giving back more than half of this recent gain, then we got to start worrying. But for now, this is a very normal pullback. As I said, no chart damage. We're still below the 200-day. We're still above the 50 and the 21. Let's go to the NASDAQ 100. This also violated a key fib level. It's a different fib set that we're using, but 286.85 has been a level that we battled for months back in May, June, July to get above that and stay above it. Finally, we did get above it. On this pullback here, we battled it again. Now we're running into it from below. We closed above it on Friday, but broke back below it. And it's a level we definitely want to pay attention to. The bad news is that we failed at it. The good news is we're still above the 50-day moving average, and the slope of the 21-day has now curled up and will be coming through the 50 later in the week if we continue to hold up. On this reversal, we sold half of our QLD. On the reversal on the S&P, we sold all of our SPXL, so taking some profits in there. Really, every time we go back and do our post-trade review, it's been fairly consistent that the best thing to do is to sell into strength and buy pullbacks during bear markets. So really, that's a little bit about what we're doing in that case. Let's go to the Dow Jones Industrial Average. This is the leader down the least today of the big caps. You can see firmly above the 200-day moving average. The slope of the 200-day is flattening out. Again, no chart damage here. Gap up, higher high again on day 3, and a reversal at this 34,000 level. The high of the day, 33,964. So pausing at a round number, we paused at that area back here in August in the rally when we got above the 200. We're pausing again there. We've certainly got some room with the 200-day being down around the 32,500 level. So Dow continues to lead. Of course, it did lag last Thursday, Friday, but we already talked about that big rotation in our Friday night video. MDY mid caps, again, 2 days up, reversal on the 3rd day, no chart damage done, still above the 200-day moving average. Small caps, little bit of damage here from the standpoint that we got above but couldn't stick above the 200-day moving average. On this, we pulled above, pulled back, and tested the 200, and it held, and we took a position in an index ETF. We close below it. If we start going lower and have a second close below it, or give up significant gains, significant in this case being more than 2%, we will get rid of that, cut the loss very quickly on that. So that was something that we added today, and we'll discuss all the trades when we go through the tail of the tape. Let's take a look at some other key charts. Let's start with the dollar. inside day with the dollar. The dollar was up most of the day, even though the indexes were rallying most of the day until the big negative reversal late in the afternoon at that key fib level. So dollar not having a big snap back to the upside, but these two gaps have a tendency to get filled on charts. So we'll be keeping an eye on that. That's the dollar. Let's take a look at the VIX. When we broke below this 24 level on Thursday, that coincided with the strong move in the markets. Little bounce today back into this 24 level. The moving averages are coming down to meet it. So for now, it's just an oversold bounce on the VIX, very similar to an overbought pullback on the indexes. As you know, the VIX and the indexes normally move opposite of each other. Here's gold, continues to go higher even with the dollar up today, coming into the 200-day moving average. Bitcoin, more fallout from this FTX nonsense. Bitcoin basically about flat on the day. TLT, this is the chart of the 30-year bond. We bounced last week, 2 days of a pullback now. Let's take a look at the impact on the 20-year, the yield. And I mentioned the charts were looking weird on Friday. I forgot the bond market was closed on Friday, even though the stock market was open. So a little bit of a bounce on yields today on the 10-year and the 30-year. Below the 21-day moving average on both of them, which is a positive for the market. One thing we will start keeping a close eye on is junk bonds. Just in case this FTX contagion, we're seeing a couple of hedge funds that have collapsed because of it. We do want to keep an eye on junk bonds, as they frequently forecast trouble that isn't apparent in the market at times. So if they are lagging the market, it's something to pay attention to. So going forward, we're going to keep an eye on the junk bond chart. So those are the major charts. Let's bring up the tail of the tape now. Put call neutral at a 0.89. The VIX up today. Fear and greed ticked down to 64. We're still operating under this rally scenario with the 1110 CPI monster gap up, 3.8% gap up at the open. Outside of COVID massive gaps up and down, I don't recall seeing anything like that recently. A little bit of news, Dems apparently are going to keep the Senate. The FTX fallout had widened. Day count, not going to go to down 1 from up 2. We'll call it up 2 with a consolidation day, as it was normal, make another high and close still relative to the prior candle in the upper part of the range. Expectations positive as long as we stay above 3,900, although this was negative, this negative reversal at these key fib levels. But again, no damage to the charts. The comment here, SPS, reject reversal at the fib 4007 resistance, and then this 286.82 level. We closed above it but broke back below it today. Sectors today, healthcare led, big cap biotech led, XME led, oil started strong, finished on the downside. Real estate and XLY and ITB were the big laggards today. Here's the focus list. We'll go through those charts momentarily. Portfolio changes on the day. GFS, one of the focus items, and we added 2% on that. We'll take a look at the chart. Added that UWM with the move above the 200-day on small caps. Added a percent to Mobileye as it continues to act well, although it did pull back later in the afternoon. Trimmed half of our QLD on that failure of that fib level, and sold our SPXL on that reversal at the S&P 500 fib level. Bottom line, S&P and NASDAQ 100 negative reversals at key fib levels, but minimal chart damage done. Let's look at some individual charts now, and we'll discuss why we're looking at them and what we were looking for. I mentioned that IWM already with the move above the 200-day. We had one close above. We were acting fine early in the day. I got above it, pulled back, held it on the bounce second bounce off of it is when we bought. One close below. We'll keep our eye on that to cut that loss small. RSP, this is the equal weighted S&P 500, and it made it above the 200-day moving average last week, but could not stay above it, so pulled back below that. That's another chart that we're going to be keeping a closer eye on. So this is more indication that it's the big cap tech that's pulling down the overall S&P 500, keeping it above the 50-day or the 200, keeping it from getting back above the 200-day moving average, as the equal weighted S&P 500 is hanging out right near the 200-day moving average. GFS, this is something that's in the 21 over 21 list, something we've been watching. When it pulled back today, we took a small entry on it, or about flat on it. End phase, this had we're watching this because it had an upgrade pre-market, sold off down to the 21 and the 50-day here, ended up still closing up 2%. Solar started off weak, but ended up just down a little bit on the day, down, and end phase stayed positive, and so did FSLR, which is one of our holdings. Started off weak, undercut the lows from Friday, and closed nicely in the upper part of its range. Next stop, Wing, keeping an eye on it, continues to consolidate here after this gap above. Chicken wing deflation is why they had a good earnings report. Celsius, this has been volatile in earnings. Initially, it had a big volume, monster gap up, ran into the 100 area, but pulled back, bounced twice at the 21, got back above the 50 today, was looking pretty good, but then pulled back along with the market. It's the stellar fundamentals in this that have us keeping an eye on it, and back to profitability next year in 2023. JBL, a lot of these electronic manufacturer outsourcing companies are looking well. This tried to break out Friday and today, pulled back along with the market, and it's not earnings related, and there's volume here. This whole group has been strengthening. There's several in here we're keeping an eye on. You can see it being rated A+. So J-Bill's what we're watching, left over from last week. Med-P, it's just been on here for a while, really, with the big gap up on earnings, tried to break out, pulled back, and then consolidating on lower volume. Some strength coming into it, but no volume coming into it late last week. That's the downside. AEHR was something we got stopped out of a couple of weeks ago, but really strong since the Thursday move up in the indexes at a new high here, or close to a new high, not an all-time high, but a recent high with the breakout. But now it's 20% above the pivot. Very volatile stock also. Lilly, LLLY, apparently the move down on Friday was due to a fake tweet of somebody that opened up a fake company account and said they're giving away insulin. But very strangely, it didn't gap down, it gapped up. It had a monster sell-off on volume early before righting itself on the day. Glad I didn't pull the trigger on that gap up, but it is holding the 21-day exponential moving average, but seems some shenanigans going on there. AMD got a big upgrade today. We discussed in Friday's video how semiconductors have been leading and showing relative strength over the last couple of weeks. It held on to its gains today, up 1.6%. BIIB also with the price target range that gapped up and held its gap. Big cap biotech IBB continues to act extremely well. Closed at the bottom of its range, tried to break out above this 135.08. That's a pretty decent looking cup base there, but pulled back along with the market late on the day. ON Semiconductor, another one we're watching with the strength on Friday and on Thursday and Friday, tried to break out, reversed along with the market. Again, this is one that is tied to the silicon carbide and sold off after its earnings report. One undercut and reclaim of the 200-day moving average, and again, strength in semis. Look at the relative strength on this over the last week and a half. So definitely something we want to pay attention to. Let's look at Mobileye and the other trades that we did today. Very volatile today. This was added to IBD leaderboard on Friday. This is what we bought it in here. when it broke above this resistance, it pulled back. IBD added it to leaderboard late on Friday. You can see the follow-through strength. This is them discussing it on IBD Live, and some people sold into it. Pulled back, one-day undercut of this 29 level, and then showing some strength late in the afternoon before pulling back into the close along with the market. This is very volatile. It's had over a 10% ATR over the past 3 days. We've got a 3% position in it, and we're positive in it. But for now, it's a failed IPO base break. It's not failed. It hasn't reached 7%. And again, 7% is an arbitrary fixed number that I don't like at all, especially when you've got a stock that you're talking about that has a 10% ATR. You just can't compare a stock with a 3% ATR to a stock with a 10% ATR and expect that a 7% stop loss is going to work on both of them. That's one of the ways that we've varied from the O'Neill rules. But nice action early. The market pulled it back. You can see it's somewhat higher after hours, and in fact, it's bid higher after hours. It's not just on the spread. So Mobileye, that was our ads today on individual positions, as well as GFS. We're still holding First Solar, FSLR. We are also holding PI, which had a decent day today, trying to get through new highs since its earnings gap up. And Steel Dynamics also had a nice day today, closing above the 100 level. You can see this resistance over here from 2 earnings reports ago, the 100 resistance level right after earnings before the pullback near the 21. And we're trying to get through that again. Good day for steel, and really for the steel stocks. The overall group is improving. We still have 10% SSO, 2% QLD, 5% in the UWM that we bought today, and then the 5 positions that I just mentioned. Our adjusted beta actually fell today with the late sells in SPXL and QLD. We're about a 0.7. In a situation that we're at here with the S&P 500 and the NASDAQ 100 being under the 200-day moving average, but above these medium-term and short-term moving averages, we kind of want to target our beta to be between 0.6 and 1.0. We got up to as high as 0.93 this morning before selling, or this afternoon with our buys before pulling back and dropping to our exposure. So 0.7, or basically 70% exposure versus the S&P 500. So that's going to wrap it. As always, love to hear from you. Email is don@revereasset.com. The phone is 855-REAL-WEALTH. Remember, folks, it's not how much you make in the market, it's how much of that you can keep. That's why our number one job at Revere is risk management. And that is going to wrap it for Monday, November 14th. This is Don Vandenbord with Just the Facts, telling it like it is. Thanks for listening, and have a great day.